Hi guys, thanks for tuning in to another episode of Nuggets News. We're back with our monthly housing and economy update with our friend Martin North. And Martin, what a time to be alive. Every month we say that, and then we get these scenes from Nepal this morning, and a lot of
I
Western
know.
governments getting a bit nervous when they see stuff like that.
Yeah, there are a lot of currents running below the surface, and trying to understand how many of those currents are really important versus just noise is actually becoming more and more a question. I keep coming back to this question of signal versus noise. What's really important versus what's just filling the airways for the sake of it. But there are some worrying signs around the place. And when we think on markets and economies and households and their finances, well, there are a lot of factors that really can bear down.
And just before we dive into the slides, I want to say congrats to you and John on doing that video on Interest of the People about that pedophile tape that aired on ABC in the 70s. And I reached out to John and had a really good chat because obviously I've been trying to cover a lot of these networks and child trafficking and all this stuff as well. So, yeah, it's amazing that this stuff seems to be coming out everywhere at the moment and people are shining truth on all sorts of areas that have been covered up for way too long.
Well, thanks for that. Yes, and we got a great reaction to it. There's more coming on the IOTP channel, and there is a level of corruption that we're seeing in many countries, but particularly in Australia at the moment. People trying to cover stuff up, but there is now a real intent to sort of shine a spotlight and really ask some important questions.
Fantastic. Well, let's dive into these slides of yours. And first up, we had this big meeting of international leaders recently.
Yeah, yeah. This was interesting. It was called the axis of upheaval by some. I think that's quite good. When you actually find India, Russia, and China, in a room together, India buying more Chinese oil, and then of course we have North Korea there for the displays as well. So it flushed out a whole bunch of questions about, well, is there a new world order emerging? Is BRICS emerging? Is the US dollar declining? Is the US declining? Now, there were a lot of articles written. It's probably true to say that there are now significant cross currents here as to how this is going to play out. But we do seem to be living in a multipolar world, and the old assumptions of the West dominated everything is probably now to be questioned. And that has very interesting implications for the financial sector and economics as well.
Yeah, I'd just add that Putin announced that Russia are launching the universal cancer mRNA vaccine. So obviously, for all the good that Putin does, and the media loves to bash him, but that is one that I'm going to be interested to watch to see how all that plays out as people rightfully growing very skeptical of all that technology.
Absolutely. Well, there's a bunch of questions arising, and of course, we've still got conflicts in Ukraine and the Middle East, and more broadly, there are a bunch of worrying signs about the way the world is heading. Some people are calling it this is a replay of the 1930s, which is concerning. And I have this theory that sometimes war is an interesting distraction for those leaders who have a particular agenda they want to prosecute. So I'm concerned about that too. But if you look more specifically about the economics, there are already some potential implications, as we can see now.
Yeah, absolutely. They love war as a distraction, but the markets continue to churn higher.
Yeah, this is remarkable. So we've got the S&P 500 and the Nasdaq hitting new highs again. And bear in mind, this chart on the page also shows that traditionally most years, September and October are actually normally periods where markets go sideways or down. In fact, some of the biggest collapses in markets in over generations have actually been in this part of the year. But we do seem to be bubbling higher. Doesn't necessarily make a lot of sense as to why we are, other than there's massive amounts of liquidity flushing around because, of course, the debt levels are very high, as we'll see a bit later. And we've also got the AI hype. And if you go to the next slide, it's worth just reflecting on the fact that it's the 10 biggest companies in the S&P 500 which are pulling away. Of course, that's all the AI hopes and dreams. Now, is that real? Well, maybe it is, maybe it isn't. But just on this idea that maybe we've hit a rather expensive run. If you look at the next few charts, I just put a few in, which we'll go through quickly, just because I don't want people to study them in detail, but to get the tenor, there are more and more people generating these views. The US stock market hits the most expensive valuation in history from bar chart. The next one is another correlation between the risk and the world index, and basically saying we're in the euphoria stage of the bubble. The next is just showing that the book to price ratio is as exalted as it was in 2001. That's, of course, the dot-com bubble, and that suggesting that maybe things are a bit wobbly. Another one here, if you look at the M2, the M2 and the NASDAQ is an interesting ratio. It's gone very, very high again, just like it was at the dot-com bubble. So all of these charts are saying, warning Will Robinson, that there are things awry here with regard to markets. And just to sort of contextualize it, if you go to the next slide, what's really fascinating is we've got now more and more funds under asset management in the US that are passive. So they're following the index. And as the indices move, they will follow. And what that means is that if there is a big reversion for any reason, all of these passive funds will follow, which means that the moves are going to be more significant. So we've built up this sort of very fragile environment. And a lot of people are saying, we don't understand how we can see this going higher. And yet the AI stocks are still rising higher. A lot of other stocks have gone sideways for quite a few years or down for quite a few years. And so we are in a very, very bubbly situation. And just on the next slide, remember...
I'll just add something quickly, Martin, on this passive slide. So this only goes back to 2009 with the GFC, when we're down to around 20% passive and the rest active. And so if we rewind back even further, back to the dot-com bubble, which you've just highlighted, it was very little of that passive ETF style investing. BlackRock and all that hadn't got their claws and everything yet. And so with the active traders, that when they saw those warning signs, and we've all seen those movies, the smart traders start to sell. But now with everyone just being passive, the ship's gonna turn. Everyone's gonna get wiped out a lot easier, a lot wider. That everyone is just in these passive funds, when the smart money is going to sell, and we're seeing that kind of rotation into gold or hard assets, Bitcoin, whatever. And now everyone else that's just got their super and just all sitting in these passive kind of ETF style funds, they're the ones that are going to get hit. And we already see it in recent history with property ETFs, where even if you want to redeem, the liquidity isn't there, because all these things are just houses of cards. Claims on top of claims, and there's just not that liquidity to actually sell the assets to get the real value that they're at. And this is just a wild situation.
It is. And remember, a lot of these passives are actually being driven by algos directly. So markets will actually rebalance themselves. So if markets move significantly, allocations change. So it's not even as if anybody is sitting in the pilot seat for a lot of the passive funds these days. Exactly. And that is a very significant, important people need to understand. The risks in this market are extremely extended. That's what those earlier slides were trying to show. And yet we've got all the talking heads talking about, the S&P 500 is going to hit higher next year, the next 2 years. But if you look carefully, quite a few of them have actually positioned on the assumption there is going to be a significant fall. And so I believe that we've got a bit of a mugs game going on at the moment, where it's retail investors who are actually sitting on these, very exalted valuations, whereas some of the more professional investors, those who are actually watching very carefully, have already taken protective positions. That's why I think we are set for a significant problem ahead. Don't know when it's going to come. It might be September, October this year. It might be down the track. But when you look at the numbers, you got to question, what the hell are we doing?
Yeah. Okay, so global debt surpassing 100 trillion.
Yeah, and another, what the hell are we doing? Government debt globally is just continuing to climb. Wherever you look, it's rising. And so I come back to this liquidity issue, and it's just very important to understand. When you start looking at asset bubbles, whether it's stocks, whether it's property or anything else, it's driven by a couple of things. The first is public debt. Governments are borrowing more and more and more and more. And of course, the interest rates on that debt is rising, as we'll see in a second. So that's going to be a significant issue. The second multiplier effect is banks, of course. Banks can create credit. If they can find people who are willing to borrow, they can create more credit. That's the way the banking system works. So effectively, you've got government policy throwing more liquidity in, you've got the banks throwing more liquidity in, and so you've got more liquidity chasing assets. That's how you get asset bubbles. That's what we're seeing at the moment. And at some point, the music's going to stop. Don't know when it's going to be, but it is worth reflecting here that there is a strong correlation between rising house prices, rising stock prices, and more liquidity in the markets.
Okay, let's push on to these government bond yields that have all spiked dramatically the past few
years. Yeah, this is fascinating. Now, let's be fair. Bond yields have come back a little bit, not universally, but the long-term bonds are much higher than they were. And in fact, a couple of weeks ago, the UK had a major shock when the UK bond yields hit a 27-year high. But just reflect on this. Longer-term government credit is actually costing a lot more than previously. That means that a greater share of taxpayer funds have to go to service those bonds. And that is something which is now putting huge pressure on the UK finances, the Australian government finances, and others as well. And the other reason to think about this long-term bond movement, this is an indicator that bond markets are saying inflation ain't dead, mate. It's still there. It's likely to come back. And I think that the idea that we've beat inflation, that's what some central banks are claiming, and therefore we can cut rates, is being questioned by what the bond markets are doing.
And I think it's the old meme of people questioning, well, take that 100 trillion figure and let's call it 5%, use some round numbers, 5 trillion a year in interest. And who do you owe that to? It's these banks that created it out of thin air, and people are starting to question, well, who invented this system? More and more people are waking up to just this idiocracy that has become modern society.
And of course, there are some financial players who are enjoying the benefits of trading the volatility and holding the assets and getting paid the coupons. But real people and real businesses are having to pay more to the government to allow the government to pay more to borrow more. And are governments spending sensibly? No. I mean, we could talk about AUKUS again in Australia and other investments too, which really aren't, worth the paper they're written on. Governments are spending big. I think they got lulled into a false sense of security through COVID when they suddenly realized that everyone said, the government can look after us. And the government said, we'll spend a bit more here and throw more money over there. At the end of the day, it's going to end in tears because there is a limit to how much governments can effectively borrow. And that's now the question. Where is the limit and what price will it be?
Yeah. Okay, so we got another court decision about these tariffs.
Yeah. And this just goes on and on, right? The tariffs thing is still morphing. They are getting some money in, but now maybe it's going to be turned. But I thought this was really interesting. The real quote here in this article was the real impact could be the power struggle between the executive and some parts of the judicial system in the US. And that is the issue. This is now becoming not just a question of tariffs, but it's a question of who's in control of the US. Obviously, the White House wants to grab greater control of everything from the Federal Reserve through to, setting monetary policy, et cetera, et cetera. This is now quite an existential discussion about the future of the US.
Yeah, absolutely. Okay, a couple of episodes you've done recently, Martin.
Well, I just wanted to highlight that with the endless rally at one hand, CEO Trump, CEO of the US, firing people left, right, and center and wanting to fire Powell or they're not. And then the question is, well, independent central banks, are they really independent or are they really just dancing a tune, and who's in control? And when you look carefully, I would argue that the central banks are part of the problem here rather than part of the solution. Now, central banks are data driven. And in the US, of course, we had another data surprise on the next slide. This is the non-farm payroll revisions dropped down by 900,000, the Biden revisions. Now, of course, they do revise these numbers quite significantly on an ongoing basis. But what it suggests is that the US economy is much weaker. The jobs creation was much slower than previously expected. As a result of that, on one hand, you would expect potentially the Federal Reserve to cut rates, and there is an expectation they will. But the inflationary pulse that we're seeing in the US and elsewhere is a lot stronger than people expected it to be. The early signs are that some of the tariffs are beginning to flow through into prices for real businesses and real people in the US. And there's more of that to come. And some of the other inflation measures are also higher too. So we are in the situation where stagflation now looks significantly more likely. And again, I would argue that the Federal Reserve and other central banks are part of the problem. They're relying on data that's not necessarily that flash. And as a result of that, they're making some really bad decisions. Sometimes I wonder whether it'd be better without central banks and their monetary function at all.
Yeah, I completely agree. All right, so the US economy depends on consumption by the rich.
Yeah, and so the consequences of all this and the consequences of the few making a lot out of the system and everybody else struggling is that you can see it here. The top 20% doing very well in terms of growth in personal spending, the middle class and the bottom 40% not so much. And we had a thing called revenge spending, which I thought was quite interesting after COVID, when you couldn't get out and people spent a lot. But now, if you look carefully, not all households, and this is true not just in the US, but in Australia too. Not all households are in the same boat. There are some doing really well, those more affluent perhaps, without mortgages, without rents, are still spending quite big, but a lot of other people are not. And some of the most recent retail data in a number of different countries are showing sluggish retail growth or focused retail growth in just a few different segments, those with more assets. So what's happening is we're creating a more and more unequal society.
And that's the worry, that if we do get a downturn or a recession, depression, that it's just the wealthy on this chart that is going to swoop in and buy all the assets up and just wipe out the middle and lower class.
Yeah, I'll just give you one quick example. In the UK, we've now got large players buying up residential real estate property, particularly in Northern England, and then leasing it back to the government for housing migrants. And what that means is that property, which used to be, standard 2 up, 2 down, houses, are now effectively multi-occupancy migrants living there. And of course, nobody in the local area would want that. And there's a really big stoush. But again, it's money being made by these big corporations and without real insight or control.
Okay, so foreign banks continuing to hoard gold.
This is fascinating. Yeah, the gold story continues. We'll see on the next slide that gold continues to rise. But it's just interesting now. We've actually got more gold held by foreign central banks than held in treasuries. This is fascinating. So, you could argue the US Treasury is now beginning to look suspect. I go right back to the top of the show when I talked about, the world order shifting. This is a really good sign that things are shifting. And if you want to go to the next slide, you can see there that the price of gold hits another new high again. And interestingly, the other fascinating point is that most of the gold ever mined still exists. But you've, of course, got interesting questions about the amount of gold in circulation. The annual production is quite low. So there is a limited supply of gold, a lot of demand for gold. And interestingly, if you look in Asia, a lot of the households in Asia used to hold jewelry, but now they're actually buying into gold or gold derivatives, so the paper products as well. And so we're seeing this broadening of the appeal of gold because people don't trust the financial system.
Yeah. And that previous chart is just crazy how quickly that's happened from, 2019 and the spread and the difference there to how quickly this has overlapped. But yeah, moving on. So Australia, economic recovery fragile.
Yeah, so of course all the headlines were, whoopee, we didn't get into a recession, because we actually, look at the GDP number carefully. Fascinating to see government spending was actually a little slower, particularly for in government public investment. That's the top right slide. The government spending on day-to-day stuff is still pretty strong, of course, but it is actually the public investment that's actually dropping significantly. So we're not investing in the future. We're just spending a lot more from the government on just paying the bills, the current bills. Most of that's something which, some of which is good, some of it's perhaps not. The current account balance has gone to deficit, and you can see there that the story is not really flash. So it's fascinating to me that the Australian economy is really sluggish, and it's only being supported, it has been supported over the last 4 or 5 years by massive government spending. I refer to my other conversations about the debt.
Yes. All right. So the RBA got that third cut in.
Yeah, so they did cut, yeah, 3.6% as sort of expected. But it was fascinating that there's now a question of will they or won't they? There was a question on the next slide, of course, here about, well, slowing productivity is a problem. They created this sort of plug number of a 0.7%. But that's a plug number off the back of the output modeling. It's not an input. It's not an assumption. It's basically just something they plug in at the end. So let's not be too worried about it. But what it basically says is, it looks to me as though, one, inflation is going to stay quite high. Look at the TRIM's mean inflation projections out to 2027. It's above the midpoint of the target. And it is fascinating to me that if you think that 2 to 3% is where they're shooting for, 2.6, that's the TRIM mean, of course. It's going up a bit higher potentially. And the issue is now the RBA is saying, well, maybe because of this higher growth that we got, maybe there isn't as much capacity to cut rates ahead. So in fact, the ANZ has now come out and said, maybe there won't be any more rate cuts, which of course is a different change in the narrative from where we were previously.
Yeah. Yeah. Do you want to talk about this RBA, this article from John Kahan?
Yeah. So just on the next couple of slides, this is the Statement of Monetary Policy productivity forecast, and you can see that they keep forecasting, it keeps going wrong. And on the next slide, you can see there that John Kehoe is talking about this productivity growth assumption of 0.7%. As I said, this is a plug number, right? This is not deep modeling from the Reserve Bank. This is basically, they got to balance their model. They mess with the productivity number. Now, if you get a 0.7% productivity, then wages are going to stay low. They're going to say it's going to be a couple of decades before we catch up in real terms. And that means that effectively the budget is going to be under huge pressure. That means that Chalmers is going to seek additional, effectively, places to find taxes. And that's important, as we'll see in the next couple of slides. And just on the next slide, you might want to see here that the growth in living standards in Australia is the lowest compared with a whole bunch of others. Chris Richardson said, thinking about the round table, I've updated the chart of living standards over the past decade. The good news is Australia's average has improved since my last update. But look where it is. It's gone nowhere compared to many other countries. This is OECD data. So there's a real issue here. The economy in Australia is not faring well, and that is putting huge pressure on the budget. And, if you go back to that round table on the next slide, you can see there they're all sitting there and talking about a lot of stuff. The productivity discussion, that was a bit of a furphy, really. But they did say intergenerational equity is the problem. And it's interesting that Chalmers seems to me to be using this as a platform to blame the oldies and say it's your problem because you're sitting on this asset that's gone up in value a lot, or your savings have gone up, whereas young people have a big issue. No. This is government policy that's created this. This is not. It's not an intergenerational problem that's been created by behavior out in the community. It's been created by bad government policy over the past 40 years. But now, of course, Chalmers wants to blame somebody else and then basically say on the next slide, I'm not going to clamp down on spending. No. We've got to spend big, despite what I said earlier on about the cost of debt, et cetera. But what they are going to do is effectively look for other tax takes, including taxing superannuation, possibly. There's even talk about taxing the family home or, looking for other routes to try and find additional tax income to support this massive government spending, which is ballooning. This is madness.
I was talking about this with some of our high net worth clients the other day about how property has just become so unattractive now in Australia. They're going to come after the spare bedroom or the inheritance, or if you own multiple properties, they're going to come after you. Like they're going to look to tax everything. You own nothing and be happy style.
Yep.
And it's just all happening so fast all of a sudden now, let alone with the increase of crime. And do you want to be dealing with tenants if you're renting in this environment with the way everything's going? It's just this perfect storm that seems to have come all at once.
So I talk about the subscription economy. Right. What it basically means is subscription housing means you'll never own your own property outright. You'll always be paying a mortgage or you'll be paying rent. Right. Or, you'll never own your car outright. You'll be paying for it forever. Right. The subscription model is here. Clip the ticket, You pay for everything as you go. And that is, of course, the model that the banks love, because they can charge you interest into infinity and continue increase growing their business. And then if you're in the rental sector, you'll be able to enjoy that stream of income, the build to rent model, which of course the government is now preaching, is very strongly there to support the cash flows into those large international investors. So the idea of you will own nothing is becoming true so quick, and we're just being lulled into this idea we'll just pay and pay and pay on an ongoing basis. This is madness. Look at how much interest you end up paying the banks, for example, over a 40-year mortgage. It's much, much higher than it used to be.
Yeah. All right. So net migration.
Yeah. So now, interestingly, of course, we had some data from the ABS, which was interpreted. This is inputs and outputs, money, people coming in, people going out. Now, people call this migration figures, and in the past, these have been imputed to actually go into the migration data, which is always heavily delayed. But there was a little bit of a Ben Fordham rant on this: 1,500 per day, latest migration explosion. But they were using the net arrivals data, which is not quite the same. And of course, that then got the ABS all upset. So they sent messages to 2GB and to Leith over at Macro Business, say, you can't use these data figures to talk about migration, right? Despite the fact that another government document says, no, this is a good early indication of where migration figures may go. And in fact, on Media Watch, on the next slide, this is actually hilarious. Media Watch then covered this and blamed 2GB for misrepresenting the data. And they managed to find an expert who said, no, migration's coming down. No, look at the data. All of the data says that it isn't. And of course, that takes us to the events a couple of weekends ago, people turning out. And it was fascinating to me how this was reported as neo-Nazis, etc. No. This was a much broader turnout from people who really care about Australia and believe that the current settings on things like migration are actually doing us no great service at all. And yet the politicians tried to white ant it, and a lot of the media reporting misrepresented what went on.
Absolutely. And, I spoke to people on both sides of these rallies, and there was just this misconception, and you can see that both sides are getting certain things pumped into them by the media. But all the people that I saw with Australian flags, it was mixed cultures and races and ages and everything. And they weren't against immigration, or they weren't racist. They're just against mass immigration while we've got everything going on currently that is in Australia. And so the media can continue to frame it as, that it's all bad and XYZ, but people know what's going on, and we know that we can make a difference by raising our voices and coming together and uniting and not falling for all the division and propaganda that is pumped into us.
Yeah. And of course, the government continues to try and detune, the debate, through social media, the misreporting of information. So, for example, there was a Media Watch story over the last couple of days that showed that some of the recent media releases, they weren't allowed to put anything other than what was in the media release. They couldn't refer to any other third-party experts. So the government is trying to control the agenda, control the story, control the social media. And what that means is it's harder and harder for people to find the truth.
Yeah, we've seen how that ends up in Nepal, as we spoke about at the start of the show.
But, absolutely, unfortunately.
Yeah. Moving on, so 5% down with everything, all the other risks that we've just spoken about, is just more craziness.
Yeah, so they've moved the dial now. So from 1 October, people will be able to grab a first home buyer house with a 5% deposit. Now, Tarek makes exactly the right point. This is not typically home buyers who benefit from the assistance. It's the sellers who receive a higher sale price. That was from the Federal Government Productivity Commission themselves. And Cameron Kushner wrote, housing prices are going even higher on the back of this, more demand, et cetera, et cetera. And interestingly, even the Treasury did some analysis to show that it's going to nudge house prices higher. So this is another example of the government doing dumb things to try and actually keep the housing momentum, because it's the only game in town from a GDP perspective.
Yeah, and if we do have a 5% pullback in property, then you're underwater. And is this another tactic to bring in that last group of young people before things roll over and really wipe out everyone, as we spoke about?
And the next slide is just the Treasury modelling. They say 70,000 people will perhaps get those. But the point I want to make is a lot of those people who are going to get the help would have bought anyway because they'd done the saving up and were ready to buy. It doesn't actually help those who really need it from an affordability perspective, who are stuck in the rental sector paying rents through the nose because they've got no choice. So this particular scheme is not going to help housing affordability in the areas that it needs to be addressed in. So this is another piece of white smoke from the government. It's just nothing to do with reality.
Absolutely. Okay, so how many houses are we going to build, Martin?
Not enough. So this is the latest dwelling approvals. It went up slightly. It wobbles a bit because of the counts and the way it works, but we're well below the target. And yet, of course, now they also announced that this is a result of the recent discussions on productivity. They're going to freeze construction codes until 2029 and try and fast track housing approvals. Now, that is not going to have a huge amount of impact. The point is the quality of construction is the thing that's the problem. The policing of the code is the problem, not the code itself and changes to the code. So this is another furphy. And on the next slide, I just got so cross, I made a show saying performative politics won't solve the housing crisis, right? This is not going to solve housing. This is not going to actually take us to where we need to go. And yet the government is spending a lot of time and effort on the supply side story. Demand is the problem. My high migration is the problem. Yes. And so there are levers that could be pulled, but no, we're not going to pull them.
Okay, so the nation's property values have ticked up.
Yeah, and then just a few slides on as we come to the end of the slide. On prices are still rising, not universally, but pretty strongly. And you can pretty much look in those major areas, and you can see the differences. It's interesting that not all prices in not all locations are going up, but that's not the way it's reported, of course. On the next slide, you can see there that the totality index shows that it's up a bit. Interestingly, units are rising less fast than houses. So standalone houses are actually the most of interest to people, but that's not what the planners want to build. The next slide is just on the data that showed that the total value of dwellings rose. This is the ABS data from this week. So we're now at an amazing $11.56 trillion of the total value of residential dwellings. The number of dwellings rose just by 53,000, so that's way below the migration number, which shows the supply-demand is equilibrium. And the median price for a residential dwelling in New South Wales, 1.25 million. Queensland, 977,000. The ACT, 949,000. NT is a bit lower. So crazy. And, nothing's going to change. And just to highlight that, on the planning side of things, we've got the Premier in New South Wales blaming the NIMBYs. And, we need to build more. We need to build up. There was an article I saw yesterday showing in Mossman, they've actually managed to find, I think, about 12 homeowners to sell their blocks together so that they can put them an 8-story tower in the middle of Mossman. It's crazy times. Councils on the next slide are fighting over the housing density. Is it NIMBY? And there are some people blaming the NIMBYism for, not meeting the supply. But my argument is we're not building the type of property that people want to live in. We're building these high-rise dog boxes. We're building the 15-minute cities. This is part of a bigger agenda. And then the last slide, just to sort of round that out, this was hilarious. We saw India talking about, well, we can help you construct 1 million homes worth $500 billion in Australia. And we'll bring Indian workers to Australia to help build them. Oh, dear. I mean, this is just the height of ridiculous. So we've got now the situation where the housing market is going to go higher. Housing affordability is going to continue to deteriorate, even if interest rates get cut a bit further. And it shows, again, the stupidity of government policy.
Wild times, Martin. Who knows what we're going to be talking about next month, but hopefully people at home are enjoying this commentary and trying to wake up their friends and family to what's going on, because we do have a great country that we can take back once we get out of the hands of these corrupt politicians. So any final thoughts, Martin?
Time to get real, Alex. Time to get real. Right, strip away the varnish of what's being, pushed out from the government sources. Get the right data, get the true data, and understand what's really going on, because that's the stage one of making change forward.
Yeah. Well, guys, all the links to follow Martin and his work down below, as well as all my research and so on. But I hope you guys have enjoyed this one. Smash that like button, share these videos around, and we'll talk to you again next month. Cheers.
Cheers.